3 reasons why adjustable rate mortgages are not as scary as they seem. Today we're going to dive into a topic that's often at the forefront of many mortgage decisions, and that is whether to choose a fixed rate mortgage or an adjustable rate mortgage, otherwise known as an ARM loan. I'm here to help you understand the pros and cons of each option so you can make informed financial choices that fit your overall financial goals. So let's begin with the tried and true fixed rate mortgage. The benefits of a fixed rate mortgage are that your interest rate remains the same throughout the life of the loan, so your monthly payments never change, and for that reason they carry the least amount of risk. So they're a great choice if you plan to stay in your mortgage for a long time, or if you're just generally afraid of risk and you don't want to necessarily take any risks that might lead to you making a higher mortgage payment over time. The downside is that you will possibly pay for that security, so you don't have the risk of your interest rate increasing, but that means that you may end up paying more interest over the life of your loan compared to if you had an ARM loan. So now let's talk about the adventurous counterpart of the fixed rate mortgage, the adjustable rate mortgage, the ARM. So with an ARM, your interest rate starts out typically a bit lower than a fixed rate mortgage rate, and it's fixed for a period of time, usually 5, 7, or 10 years. Now, almost all ARM loans are 30-year mortgage terms. It's just that the initial interest rate is fixed for the first 5, 7, or 10 years. So that means if you see a product called a 10-year ARM, it means that the interest rate is fixed for the first 10 years of the 30-year term. However, there's a catch. After the initial fixed rate period, the interest rate can change periodically, usually once a year or sometimes once every 6 months. So that's kind of like riding a roller coaster. Your payments can go up or down based on the market interest rate, which can definitely be a little bit scary. The benefits, however, of an ARM loan are that during that fixed rate period of time, since you're taking a lower interest rate than you would be if you had a fixed rate mortgage, your payments are lower. So you're saving interest each time you make a payment for 5 years, maybe 7 years, maybe even 10 years. And those interest savings can accumulate to be a substantial sum over those first 5, 7, or 10 years. And if interest rates, let's say, stay stable or they decrease even after that time, you may end up paying lower costs or a lower interest rate the whole time. It's certainly possible. ARMs are a good option if you plan to sell or refinance your home before the rate adjustment, or even within the first few years after the rate adjusts, mainly because you have already saved a lot of that money up front. So even after the rate adjusts, if your rate goes up, but you have this big pool of savings, even if you're paying a higher rate on the mortgage for a period of time, you still start out net positive, until you maybe pay all of that back, that is. So it's also important to understand that just because the rate adjusts doesn't mean that it increases. Your rate adjustments, depending on the market, could leave you with a lower interest rate than you had while it was fixed. So I don't think that's talked about a lot when you talk about interest rates when it's a fixed rate mortgage versus an ARM. The assumption is that it just kind of balloons and goes crazy. It's not really talked about that your interest rate actually might decrease. Now, the downside of ARMs is the risk. Your payments can increase after that initial period. You might face some uncertainty if rates rise significantly. Interest rates on ARMs, by the way, they can't just go to like 40%. There's caps in place, which we'll talk about in another video, and just in determining how to shop for an ARM and kind of all the ins and outs of ARMs specifically. ARMs do not just balloon into a crazy interest rate. There are certain rails and boundaries that they can't cross. So to put it simply, if you're okay with taking some risk, as long as you understand what that risk is, you may want to consider an ARM and have a home loan advisor explain to you how ARMs work and how they can be beneficial to you. On the flip side, if you're very risk adverse and you just kind of want the peace of mind that your payment would never change, it may be best to go with a fixed rate mortgage, even though it could possibly cost you a little bit more money in interest. Peace of mind is worth quite a bit, and so a fixed rate might actually be the best way to go. Fixed rates are the most common, and I usually do recommend a fixed rate mortgage to most folks unless they are a little bit more financially savvy or interested in learning about ARMs. So typically the fixed rate is usually the safe play. Remember, your mortgage choice should align with your financial goals and your risk tolerance. So whenever you're making this decision, just try to make sure that you're considering all the options out there and not just going with something because it's the most common or because it's the only thing that you've been offered. And there you have it. So that's a closer look at fixed rate versus adjustable mortgages. Whether you choose the stability of a fixed rate mortgage or the potential savings in ARM, I'm here to help you make the best financial decision for your unique situation. If you have any questions, feel free to reach out to me. Mortgages are complex, so let me give you the tools that you need to make the right financial decisions. Thanks for watching.